Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Lawrence Cunningham, professor of law at George Washington University. Professor Cunningham is considered a leading scholar on Berkshire Hathaway and Warren Buffett, and has written multiple books on Berkshire's business model and culture, Buffett's shareholder letters, his investing approach, and much more. He's also spent considerable time on the concept of high-quality shareholders and the types of companies that attract these long-term, highly concentrated investors. This podcast is full of thoughts and insights on Buffett and well beyond. The professor also shares one of his most memorable moments with Warren and the great advice he was given years ago. As always, thank you for listening. We hope you enjoy the discussion. Oh, one last thing. If you find this episode particularly valuable and you leave a review on Apple iTunes and take a screenshot of it and send it to us at info@validia.com, we'll send you a free copy of Professor Cunningham's book, Dear Shareholder, the best executive letters from Warren Buffett, Prem Watsa, and other great CEOs. Thanks so much. Professor, thank you very much for jumping on with us today. We very much appreciate it. We're looking forward to a really good discussion with you. There's a lot of things we want to get through. So the first thing I want to ask you is about a man and a company you know a lot about, Warren Buffett and Berkshire Hathaway. By my count, you've written, and correct me if I'm wrong here, 5 books that weave together Buffett's shareholder letters, the quality of his shareholder base, Berkshire Hathaway's corporate culture, and much more. I think, let me just read these off real quick. How to Think Like Benjamin Graham and Invest Like Warren Buffett, the Essays of Warren Buffett, Lessons for Investors and Managers, Dear Shareholder, the best executive letters from Warren Buffett, Prem Watsa, and other great CEOs, Margin of Trust, the Berkshire business model, and the Essays of Warren Buffett's Lessons for Corporate America. Am I missing anything?
No, and thank you very much for running down the whole list.
Sure. Okay, that's a lot of writing, a lot of books, good stuff. So you know, you're really a student of Buffett and Berkshire Hathaway, and you know where I want to focus this first question for you is, you know, with Buffett, he's achieved success that no other investor has been able to in history. I think his returns are something like 20% annualized returns since 1965. Given that he's achieved something that arguably no one else has been able to do and no one else probably will be able to do in the future, you know, what are the key traits, what are the key things in your mind that has allowed him to produce those results and achieve something that no one else has done ever?
It's a great question. And I guess the first point I'd make is that I do think it's more skill than luck. You know, a lot of critics simply say, well, you're going to see a lucky person like that every once in a blue moon. Luck has certainly played a role in Warren's career and success, but skill has been obvious. And I think that that's an important threshold point to make. There's something about what he did and how he approached things that matters and other people can learn from. And I think you're right to resist boiling it down. I think there are many different personality traits, intellectual habits, economic outlooks that have played a role in helping Warren to be very good at identifying excellent businesses, waiting for the prices right, holding for the long term. And so, but I do think if I was pressed, you know, for the rest of us to think, well, what can I do differently or better? I think the bottom line on him is, I'll call it absorption. What I mean is he's been a learner his whole life. He's read a lot, well known for that. He's paid careful attention to the thoughts of others from all different points of view. He's weighed evidence. He gathered a lot of evidence and thought about things carefully and has a high absorption rate. So he gathers lots of information and then analyzes it. So, and then within that framework of mostly skill, heavy absorption. I'd say disciplined rationality. Again, something all of us could potentially do better. All of us make basic psychological mistakes, or sometimes they're sensible and practical. If you're engaged in behavioral propensities that might lead you to a sub-rational decision. He's been very aware of those realities of human thought and behavior, and has done a really good job of controlling his own. So that kind of disciplined rationality, and it translates into being patient, waiting for the right pitch, as they say in baseball, as he says a lot, waiting till the opportunity to swing and make it is so obvious that it's hard to make a mistake. So it's a bundle of things, but there are a few core principles there that I think all of us can benefit from, especially that idea of absorbing lots of information and trying to be aware of our behavioral tics and to control them.
That's great. Thanks for getting some specifics on that. Waiting for the fat pitch, I think, is what Buffett likes to say, waiting for that opportune time to make his investment. One of the other concepts I wanted to ask you about is the concept of Berkshire being able to attract high quality shareholders. I know this is something that you spent some time on in your paper, The Case for Empowering Quality Shareholders. You present this 2x2 matrix of different types of investors. So you have your transients, which are low conviction, short-term time horizon investors, your indexers, which are essentially low conviction, but long-term time horizon investors, activists, which are high conviction and short-term, mostly time horizon type of investors. And then you have this sort of fourth quadrant, which is the quality, high conviction, long-term time horizon shareholders. So I wanted just to see if you could talk about what those major attributes are of the high quality shareholder, sort of flush that out a little bit more. And then, sort of contrast that with some of those groups. I mean, I kind of did it at a high level, but if you just want to speak to that, I think that would be very interesting.
Yeah, thanks. That matrix tries to capture today's general shareholder demographic. And I think those are the four major categories. It's important because the dominant ownership of corporate America today are those indexers, that is long-term but not concentrated, which own about 40% of corporate America, and the transients, the short-termers, who just are in and out, momentum traders, ARBs, just opportunists, and they own about 40%, depending on how you count. The activists are moving in and out at various places. They have higher or lower stakes at various times, but roughly they command about 5% of the public equity markets at any given time. So it's only about 15% of today's shareholder demographic that are long-term and concentrated. But they will probably be the group that is most able and willing to make the most valuable and rational long-term decisions on shareholder voting, like director elections, mergers, big asset sales, and other things, compared to those other groups. All the groups contribute something and contribute something valuable. The transients contribute liquidity and deep capital markets, which is extremely valuable. The indexers contribute the possibility for millions of ordinary people to get the market return at basically zero cost, zero risk. So they all play a role, but you've got to have a group that is focused and long-term in order to have rational pricing and optimal business decisions. So I think that cohort is increasing, it's getting smaller and smaller, has been getting smaller and smaller over the past 20 or 30 years, and is they're increasingly important. And so I've begun a research project on that, really on all shareholder groups, but focused on the advantages of that quality shareholder cohort and how companies might try to attract them, and indeed who they are and which companies have attracted them in high density.
I wanted to ask you about the indexers quick before we talk a little bit more about this, because it's something a lot of people tend to be worried about for a lot of reasons, which is this whole increase in the percentage of the market that's owned by indexers. From your perspective, as that rises, it seems like we're going to have fewer and fewer high quality shareholders. Is that something you're worried about from a corporate governance standpoint?
Yes, I am. That's my major worry. And I can say, you remember Jack Bogle, who is credited with inventing the index fund. He was certainly an intellectual pioneer. He wrote his Princeton dissertation about the concept in the 70s and went on to build up Vanguard, which specialized in the practice. And he made a name for himself as the way that ordinary people can get a stake in the market, get the market return at low cost. And he was very proud of that accomplishment. Jack was a friend of mine. I was proud of him too. He once made a joke, one of the books that you mentioned, Justin, the How to Think book. I asked Jack for a jacket blurb, and he called me back and said, I'd be happy to do it, because I think what you and Warren are talking about, that kind of investing, it's the second best kind of investing in the world. It's insane. Indexing is
right.
best. But even Jack, just about 6 months before he died, he ran an article in the Wall Street Journal, did a bit of interview with them saying, yes, I created something wonderful. I'm proud of it. I'm sticking with that. But if it gets too big, there will be a problem. And he didn't say exactly what too big was, but he was saying it may be getting too big too soon. That is, if BlackRock, Vanguard, State Street, these behemoths that own commanding shares, but even all the smaller ones, and these just ordinary, small funds that just index, they don't have the resources to study individual companies, to make decisions about who should be on this board, or whether they ought to have a staggered board, or whether the CEO and chairman ought to be split, whether they ought to make this merger. They simply don't have the resources to do it. I mean, the business model is exactly the other way around. Buy small stakes in basically all the companies, and then you don't have to worry about individual companies. So they simply don't have the resources. But somebody's got to make those decisions, and the rational decision will vary with different companies. For some companies, a staggered board is a bad idea, but not for others. For some companies, splitting the chairman and CEO is a good idea, not for others. And particular mergers obviously vary with every transaction. So it's worrying. And look, the big firms, all three of them in the past 18 months began to say, we're going to increase our resources allocated to proxy voting. We're going to have a team of people study companies and study issues and make decisions. I appreciated the language, but then the staffing was minuscule. I think BlackRock put 40 people into this area. They follow tens of thousands of companies. So I worry a great deal when we have this kind of generalized proxy governance, and it one size does not fit all in most aspects of corporate governance, and so it's very important that we have some shareholders whose incentives and inclination are to study particular companies and then be prepared on a moment's notice to decide, yes, we ought to elect this person, or yes, we ought to adopt this climate change policy, or what have you, rather than having a generalized system-wide set of rules.
I want to ask you about how to identify these companies with the high density of high quality shareholders. You've been, I've been reading your Twitter, and you've been posting occasionally some companies that meet your criteria. And we're quant investors, and so I'm always interested when I hear something about this, about how do I actually go in the data and how do I find these companies. So I'm wondering if you could talk a little bit about this high conviction, high holding period, these types of investors. How do you go in the data, and how do you actually identify these companies?
Yeah, sure. I've got a whole write-up of the methodology that we use, and it'll appear as an appendix to my book that's coming out in the fall called Quality Shareholders. It basically reports two different things. One, a canvas of the existing research around this question of who are the quality shareholders, which companies attract them, and then an original data crunch empirical study that we did combing through 20 Fs. On the former side, we look at, I think we have 15 or 20 different studies of various kinds that try to probe for which stockholders, which institutional investors have high average holding periods, and then and which of them have relatively high concentration levels. And these studies then turn around and identify a lot of these, what I call quality shareholders, a term Warren minted, by the way, back in the 70s. And so we looked at all of those studies and made lists of which companies they identified that way. And then there's a little more informal, almost anecdotal literature, popular books on concentrated investing or on value investing by Tobias Carlyle, Seth Klarman, and others who and even essays that Warren has written, his famous essay in the Hermes magazine of Columbia Business School identified 10 different quality shareholders. So we combed through all of that literature to try to identify who seems to be recognized as quality, measured in this way, high concentration, long average holding periods. And then we turned around and tried to figure out, well, in which companies have they invested significantly? And then we turn around and look, are those companies attracting other quality shareholders in high density? So that was I'd say was somewhat informal canvas of the available commentary on the population. And the neat thing about what we saw was there tended to be a consensus. The same names popped up frequently and so on. So there weren't a lot of anomalies in what we read. And then we turned around and did a heavy-duty empirical study where first we crunched the 20Fs basically for the last 5 years, all funds with assets under management of greater than $1 billion. And we did developed a lot of different measures of duration and conviction to try to look at the company, look at the funds from as many different ways as we could, and we'll explain all this in this appendix, and then rank them 1 through, I forget how many thousands were in there, according to this matrix of concentration and duration. And they lined up again reasonably well with what we saw in the survey part of the study. There were not huge surprises to us, and we got a whole list of who those companies, who those funds are. And when I've circulated that list informally among people in the ecosystem, people say, yeah, that looks right to me. Every once in a while, you'll see, oh, that's a little bit of a surprise. And some of the Twitter feed has a little of that commentary in it. And then we took the second half is, well, which companies tend to attract this type of shareholder in high density? And so, here we took a bunch of similar proxies and applied them to some, I think we had 2,300 companies, most of the Russell 3000, and identified which of these tended to attract quality shareholders in the highest density and ranked them, again, 1 to 2,300 or whatever it was. And then cross-check that in various ways, examine the lists of selected companies on that index, just to sort of verify it. So those are the two steps. First, identifying the quality shareholders. Second, identifying companies that seem to attract them in high density. And then the third part, which is the hardest, on that second part, when I share that list of here are some companies that attract quality shareholders in high density. Again, people in the ecosystem, people who this shareholder cohort tend to nod. Say, yeah, that doesn't surprise me. That's a company that I would expect to attract this long-term concentrated cohort. And then the third thing we do is try to figure out, well, what is it about these companies that attracts that cohort disproportionately? And this may be the hardest part of the project. I mean, the other parts were hard too, but we have examined 20 or 30 different potential hypotheses around communications, capital allocation strategy, signals about time horizon, and so on, and then try to probe which of these seem to be explanations for this effect. And the idea there is that if a company or a board or CEO had a thought that we'd like to have more long-term concentrated shareholders, that we got plenty of indexers and we got plenty of transients, we'd like to have more of this stable committed group, and they ask themselves, what could we do to attract them? This part of the project is designed to offer some suggestions about what they might do.
Yeah, that's interesting, because that sort of gets at what I was going to ask next, which is how do companies, if I'm running a company, what do I do to try to attract these people? And I wanted to ask you it from the perspective of Tesla. You had tweeted about Tesla recently and said, Tesla has a very high quality shareholder base. And you were talking about sort of they may end up in the S&P 500 and they may get a bunch of indexers in there, and that may degrade it to some degree. But they've also got another thing going on in Tesla, which is because the stock is up 3 times or whatever it's up this year, they're also tending to get these transients in there now, the day traders and the barstool sports people, and they're all tending to come into Tesla as well. And I was wondering, if you were advising Tesla, what are some of the things they could do to maybe maintain that high quality shareholder base when it's maybe getting attacked from different directions?
It's a great question. And I just read this morning, because of that stock price appreciation, galloping in just the past year, that the board is proposing to split the stock 5-for-1. And that's I would oppose that, and I would recommend that they not do that, precisely for this reason, that stock splits was one of the factors that we examined to test whether a propensity to do stock splits is associated with a high or low density of quality shareholders. And it turns out it's associated with a lower density of quality shareholders. And maybe it's obvious. The rationale is to entice more people into the stock. And if you're enticing more people into the stock, well, you're probably going to entice some churn in that stock. If you're aiming for the barstool folks, you're way more likely to get higher turnover, higher volatility, and more transients rather than higher quality. In fact, when you flip it around, if you go and look at the companies with the highest stock price, Berkshire's got the record, with 6 figures, but there are a bunch, not many, but some with 4-figure stock prices. And almost all of them have very high densities of high quality stockholders. And so, and if you look down at the other end, companies that have split their stock with a high degree of frequency over a period of time to keep the price low, keep it attractive to larger numbers of people, they tended to attract lower density of quality shareholders. So I think that 5-for-1 split is a big mistake. If what they were after were high quality shareholders, I think that's a big mistake. So I'd advise them against it. Apple's doing that too. I'd advise them against it too. But I said that about Tesla because I think they've attracted high quality shareholders, but it may not be because of anything that the company consciously set out to do. It may not be something Elon Musk really even cares about. But they've just happened to do it. It may just be the economics are mouthwatering, and that kind of shareholder has a good sense for appealing investment opportunities. But I'd be against that split, and if I would not be celebrating the fact that they're getting in the index. Again, I think you're obviously just going to attract a larger cohort of indexers who simply have to own the stock because it's in the index. So I might just go back to, if Elon cared about the shareholder base, I might go back and review with him the whole concept of a shareholder base. Not too few CEOs actually even think hard about who are our shareholders and what will it mean for us when we get into a particular activist situation or proxy battle.
Yeah, maybe he should stop antagonizing the SEC on Twitter as well. That may not be that also may not be in his best interest.
Or going on Joe Rogan and smoking pot with him.
Yeah, I think Elon is not necessarily the poster child for a CEO of the year. I mean, he's successful in all sorts of ways. I'm not criticizing, but he's not. I doubt that he would care as much as I do about, is our shareholder base a quality shareholder base or not?
Right. No, we gotcha. Speaking of Apple, this is one of the questions I wanted to ask you. And I think it kind of relates to what you said before about Buffett, but Buffett was obviously slow to invest in technology. I think it probably initially started with IBM, which that ended up not being a very good investment. But then a few years ago, he added Apple to the public stock portfolio, and now Apple accounts for the largest position of Berkshire's publicly traded holdings. So Apple, I think last time I looked, which was just like the other day, $110 billion position for Berkshire Hathaway. And the total public portfolio, the investable assets, is about 240. So Apple's almost, getting close to a 50% position within that group of stocks that Buffett owns. So I guess the question that I wanted to sort of get at there is Buffett, has migrated over the long term. He was initially a deep value investor, sort of from the Graham style of investing. Then he moved to more of a blue chip, high quality compounder. But making those transitions is just, I would imagine, is extremely difficult. But maybe the best investors are able to pivot and see and realize that, now it's time to maybe be looking at these stocks when I haven't before. But I mean, do you just have any thoughts or insights about Buffett's ability to do that and how that has maybe in some cases helped them, in this case of Apple, or in other cases maybe it's hurt him? I don't know, but I just wanted to ask you about that.
Yeah, Justin, it's a great question. And I think you're right to identify those big investment philosophy pivots from the Graham deep value cigar butt approach, which shifted almost in a transaction in the acquisition of See's Candies at Charlie Munger's encouragement to focus on brands and franchise value and pay up a little for quality. Then he pivoted again, I guess, roughly around 2000, maybe 2010, from a kind of low capital intensity focus to a significant capital intensity focus, especially BNSF Railway in 2010 and then Precision Cast Parts in 2017. So he is agile. He is adaptive. As we said in the beginning, I mean, he's a learner and he learns as he goes. And he's also a contextualist, that, his judgments are made in the context of what his asset base is, what his intellectual capabilities are, and who's around him. And I think the Apple move is interesting. I think the funny thing about IBM is they had a big position and it didn't do well. And that was kind of a tech company that moved too slow. Warren's concerned about tech was he can't predict the business in 3 or 5 or 7 years. And, with IBM, I think one of its problems was it didn't change fast enough. With Apple, I think it may be less that Warren has adapted his own acuity or ability to analyze future cash flows of a tech company than that. Apple it's a lot easier to understand that technology than, say cloud computing in 2010 or even the basic internet in 2000. So it's just an easier business to get your hands around. And I think that the principal decision makers at Berkshire on that investment were his two portfolio managers, Todd Coombs and or Ted Weschler, as much as it was Warren. So I think this lesson around pivot isn't so much, that he has changed his view or changed his abilities or the world has changed, but that he has grown Berkshire in a way so that he makes fewer and fewer of the most important decisions, and he's pushed more and more responsibility down to the team around him, and which I think is extremely important. When you think about Warren pivoting, he's pivoted not only as an investor in the ways you've described, but also as a manager. So beginning in about 2000, when the company really shifted from being mostly an owner of marketable securities to mostly an owner of operating businesses, he realized more and more every month that he can't make most operating decisions. And so even as the company has grown larger and larger with vaster businesses all around it, he's done less and less decision making. He's delegated more, he's trusted more, and that's come into the investment side too, by hiring Todd and Ted, giving them increasing levels of responsibility. And so now, the number one stock in the portfolio by size is really a decision, I think he may have approved and so on, but it wasn't his brainchild. And so, I think you're right, absolutely, that he's able to pivot, has done that maybe every decade in a measurable way, more frequently. And I think this current pivot is really about almost, maybe it's the next question, but it's really about what's Berkshire tomorrow, what's Berkshire after Warren. And I think that's maybe the ultimate pivot.
For sure.
Yeah, I wanted to pick up on something you said about Buffett's sort of his change towards investing in high quality companies. He started at the beginning, maybe buying the cheaper stocks, and then moved towards high quality companies. It seems to me like that's one of the most difficult concepts to define in investing. It's pretty easy to figure out maybe what a cheap company is, but when you talk about quality, it's one of those things where you know it when you see it, but it's hard to figure out what it is. And I know you wrote a whole book on quality, finding high quality companies. And I was wondering if you could talk a little bit about what you think the common attributes are that high quality companies have.
Yeah, sure. It's a great question. And I enjoyed writing that book. It was with investors from the AKO Capital firm in London, which specializes in hunting for extremely high quality companies, and then acts as a quality shareholder in buying very large stakes and holding them for indefinitely. And it was fun to do that work with them. We basically excavated their investment process and examined their decision making and crunched through all the analysis that they had applied to their decisions over 10 or 15 years to identify these quality companies. And it was almost a lesson in microeconomics or industrial structure. We're looking at the composition of the industry, the sorts of competition, the pricing power, the branding effects, ultimately moats, the competitive advantages that would enable a company to deliver sustained high returns on invested capital. And so that's what we probed, and there are many ways to do it. We have some examples such as a friendly middleman, where a company that's able to use the intermediaries between themselves and a customer. So a plumber recommending your brand of pipe, or an eye doctor recommending your brand of eyeglasses. And if you're able to cultivate that, it creates a bit of a barrier, creates a competitive advantage against rivals who don't have that special relationship. So we identified a dozen or more of these sorts of moats, these sorts of competitive advantages. Others have done it too in different ways. Warren obviously always speaks about having a moat and having a competitive advantage, and what is it that enables, what is it that protects your business from rivalrous invasion. And to your point about measuring that, it comes out in the results, and I think the ultimate measure is return on invested capital over long periods of time. And then that's the first place to look. If you're trying to scout out for who are the quality companies, in which company would it be attractive to deploy this capital investment, you first look at that track record. Have they been able to outperform on a consistent basis for a significant period? And then you look inside to what accounts for that. Do they have a brand advantage? Is there a network effect? Is this a mission critical product? Do they have a friendly middleman? And then you probe that. And so is the competitive environment rational? I mean, is it likely that rivals are content with some level of profitability given market share, or is there some risk of disruption by an existing irrational competitor or some disruptor from outside? So you sort of walk through it that way and come to a judgment that this is a business that commands some sustainable advantages and it's not selling at some outrageous price. Then that may be a good, appealing quality company for an investor willing to hold for an indefinite period in a meaningful concentration.
I wanted to ask you about quantifying something like a moat. You talked about some of the criteria you talked about, like sustained high return on capital is something that can be quantified. But then some of the other stuff you talked about is something that would be more difficult. And, we're, as quant investors, one of the things we've always tried to do is we've tried to figure out, what criteria could we use to identify companies that have a moat? And I was wondering what you think about our chances of doing that. Do you think a person is much better suited to trying to identify these companies that have a moat, or do you think we can maybe get most of the way there with more of a quantitative strategy, looking at the fundamentals of the company?
Yeah, my guess is that your quant approach is going to be more reliable. It should be checked with human judgment, but I think you're trying to do analysis that requires pretty heavy duty statistical work around holding certain variables constant and testing dependent variables. So I think that your quant method is probably more promising in trying to measure the contribution, let's say, of any given company may enjoy multiple moats, and they may all contribute in different ways to the measurable output. And so trying to estimate what those are is extremely difficult. And I think you're more likely to get some parameters around that with the kind of quantitative analysis you're doing. But then I think, as with all statistics, you need to then step back and apply human judgment on whether this sounds right, whether this seems to make sense, and have some human checks on the data.
Do you have, obviously Buffett, when Buffett's shareholder letters are published, it's like they're highlighted in the media. I mean, I'm on Saturday morning, digging in, reading it. And so clearly that's a very, investors are very interested in what Buffett has to say and the wisdom that he's sharing. But if you could identify, maybe it's not a top 10 list, but what other CEOs are articulating their vision and their knowledge through shareholder letters? Like if you were to try to highlight the ones that you think are sort of capturing what Buffett is doing, maybe they're not talking about investing, they're talking about the direction of their company and sort of their vision for it. But do you have sort of a short list of other CEOs and corporate leaders that are doing a really good job with their shareholder letters?
Yeah, thanks, Justin. I've got a book on that one too.
There we go.
And the way I could read you. I think I've got 15 names in here, but I won't be that tedious. But it is an interesting question, because how did I come to have this answer? As I've been doing the research on who are the quality shareholders, which companies attract them, and what are the factors. One of the factors that we're concentrating on is communications. So broadly, how does the company reach its stockholders, and what does it say? And so we thought annual meetings, quarterly calls, communications, and annual letters. Before I get into this list, I'll just say earlier we said what levers, what corporate policies attract different kinds of shareholders. So this may be obvious too, but it's really important, is that if you're trying to get transient shareholders, if you like a lot of short-term people, then have a quarterly call every quarter, make forecasts and indicate how you're meeting them. that's what attracts transients. And flip it around. If you want to avoid the transient cohort, you want to have fewer of them, more of the quality shareholder cohorts, skip the quarterlies. Don't make forecasts. Don't have analyst calls. Speak to the holders once a year. Or you could do Q&A throughout the year, as Joe Mansueto was doing at Morningstar. I think they still do, and some other companies do. But that quarterly communication attracts transients and repels quality. A good, high-quality annual shareholder letter attracts quality. And so I have a whole chapter in the Quality Shareholder book about what an annual letter that attracts quality shareholders probably looks like in terms of candor, metrics, explaining fundamentals like capital allocation, and stressing business strategy over multiple years rather than quarterly results. And so I lay out a bunch of features of the shareholder letter that attracts quality shareholders. And then as I inventoried that material, and I read dozens of letters from hundreds of CEOs, I was able to distill it down into little chapters. And so I decided, that was the research that enabled me to write my chapter, but I decided, let's publish those. So I took the best of 20 of them and published this book, Dear Shareholder. And I have to say, Warren leads it off. I mean, he's the gold standard in the shareholder letter, Justin, as you just explained. Every April, whatever that day is, March, millions of people download that letter. He perfected the art. He wrote compelling letters almost from the beginning, really developed it into an art form. I've written extensively about the writing his writing style, how he's able to entice such a following, because it's a lot of its substance, but there is also a way that he puts things, aphoristic, it's illustrations, humility. But in terms of quality shareholder, focus on the long term, discussion of business strategy, explanations of rational capital allocation, and so on. And so that he provided the gold standard and sort of the framework for this. Some other people that I've put in here, I mentioned Joe Mansueto from Morningstar, wrote excellent letters. He retired a couple years ago. His successor, I think, is trying to do the same thing. Ian Cumming and Joe Steinberg at Leucadia were excellent writers of corporate shareholder letters over a 35-year career. And those two, I think, would be especially appealing to your audience. That these guys were investors first. They built up Leucadia National into an operating conglomerate, a little bit like Berkshire, I guess, and some different principles. They were not buy and hold. They bought opportunistically and sold when that was profitable. But their letters explain their investment strategy. It's warts and all kind of guys. And here are the dumb things we did or the challenges we can't get over. But here's how we're thinking through. And just wonderful, wonderful letters. I have to say the Markel Corporation letters are outstanding. This is an insurance company, a lot like Berkshire. It's a third-generation Richmond-based company, specializes in niche property casualty, but a lot of niche insurance companies. They've got an impressive value-based stock portfolio, very quality shareholders, along with a merchant division where they buy and hold companies, and write outstanding letters. Tom Gaynor is the CEO, and pithy, wise, funny, candid, clear, long-term, shareholder-focused, very owner-oriented. And then, I should say my friend, I'm on the board of Constellation Software, and Mark Leonard, the chairman and CEO, had for 15 or so years written letters that were followed as avidly in his world as Warren's are in the world at large. I've got some samples from him. Very, very rational, deep, analytical, owner-oriented, very long-term. And I guess one of the best things about all these letters is they, like Warren's, they're a mini course in business management, business strategy, business leadership. I mean, it's not a substitute for an MBA, but it's the kind of thing that any person thinking about business school or even majoring in business, focusing on investment would, I think, benefit from reading.
Professor, what we're going to do is we're trying to get reviews for our podcast. So what I'm going to do is if people actually leave us a review and they like this podcast, I'm going to buy them a copy of your book. Deal?
Oh, thank you. That's great.
Yeah.
Yes, thank you.
We'll buy a few copies and we'll ship them out to people that are finding this valuable. The last question I just wanted to ask sort of before we wrap up, and this might be a tough one, but I mean, we talked a lot about Buffett. We started with Buffett. You shared your wisdom and your experience and learning from Buffett, but what is your most memorable encounter with him? If you could kind of highlight, the one encounter you've had with Warren, I mean, what stands out the most in your mind?
Justin, I think you said this might be the hardest question. It is, because immediately a fairly large number
right
come to mind. He is, I think he's what you see is what you get. And so, that folksy, friendly, avuncular sensibility is what comes across in all the encounters. And so I want to try to share such a insight or story with you. I could give you 20, and someday I should maybe write them down. I've never done that. But I'll take us back to the Essays of Warren Buffett, Lessons for Corporate America, where it's 1995, and I'm running a corporate governance program at my university, and I decide I'm hosting events and gathering knowledge, and I think it would be a really neat thing to have a symposium featuring his letters, and I would rearrange them and have him there and his entourage and my colleagues, and that's what we did. We put on this whole show, and it was just wonderful. We had 200 or so people, mostly students, in the audience, and we debated every idea in the book, from accounting to valuation, mergers, governance, taxes. It was just a wonderful event, and it got a little bit of press. It got press. Forbes covered it. Fortune did something on it. It was covered by the FT. It was more than I expected. And the result then was that all the big time book publishers were calling me saying, well, can we publish that book? We'd like to publish that book. We'd like to publish that book. And I had just planned on publishing it as a journal article, journal feature. And so, these big time publishers are offering insane advances and royalty ladders and inducements. They were trying to make me feel like a kind of rock star or something ridiculous like that. So I called Warren and I said, here's these firms have, because they had gotten a copy of it from the symposium. This firm has offered this amount of money, which was fall off your chair money, and so on. And he said, Larry, you do whatever you want, but I don't think you should do that. In the publishing business, the publisher will take total control of all editorial, marketing, positioning, everything else. And that sum of money that you're looking at there, it sounds enticing and so on, but if you are in control of everything, first of all, you'll get a lot of benefit out of that. And you don't need their help to achieve those results. So do whatever you want. This was in, as I said, 1997. So Amazon was just created. The internet was just born. So you had to sell books through Barnes & Noble and Borders and places like that. And so I accepted. I took what he was saying, right? So I self-published the book. And for 10 years, I'd package the boxes and send them out, UPS, and I self-published. I did everything. I eventually partnered with a distributor to help me do it. But he was absolutely right. I love publishing the Essays of Warren Buffett. It's the neatest thing I've ever done professionally. And he was absolutely right. I published with publishers, and I have nothing against him, but for that product, he was just absolutely right. That kind of wisdom, and that kind of long view was extremely valuable to me. Thanks for asking.
Yeah, that's a great story. Classic Buffett advice, thinking long term and not so much in the here and now, even though it might have been a lot of money, but that's a great story. So thank you. So Professor Cunningham, this has been awesome. It's been a great conversation. Thank you for joining us. If people want to learn more about you or get any details on your books or your writing and research and projects that you're doing, where can they go to find and learn more about you?
The best place these days will be on my website for the Quality Shareholders Initiative. That's the research project I mentioned. It's at George Washington University. So if you type in GW, Quality Shareholders, and my name, you'll probably get right to that site. And it's got links to the publications and research and videos, and we'll continue to populate it.
Great. We'll definitely put a link to that in the show notes as well.
Thanks.
All right. Thank you, Professor. We appreciate it.
Thank you. It's a pleasure.
Have a good one.
You too.
Bye. Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.